Ladies and gentlemen, Vice President and I are very pleased to welcome you to our press conference. We'll now report on the outcome of today's meeting of the Governing Council. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. Incoming information has confirmed our previous assessment. Underlying price pressures in the euro area are expected to remain subdued over the medium term. In keeping with this picture, monetary and in particular credit dynamics remain subdued. Inflation expectations for the euro area continue to be firmly anchored, in line with our aim of maintaining inflation rates below but close to 2% over the medium term. At the same time, recent confidence indicators based on survey data have shown some further improvement from low levels and tentatively confirm the expectation of a stabilization in economic activity. Our monetary policy stance continues to be geared towards maintaining the degree of monetary accommodation warranted by the outlook for price stability and promoting stable money market conditions. It thereby provides support to a gradual recovery in economic activity in the remaining part of the year and in 2014. The Governing Council confirms that it expects the key ECB interest rates to remain at present or lower levels for an extended period of time. This expectation continues to be based on an unchanged overall subdued outlook for inflation, extending into the medium term. Given the broad-based weakness in the economy and subdued monetary dynamics. In the period ahead, we will monitor all incoming information on economic and monetary developments and assess any impact on the outlook for price stability. Let me now explain our assessment in greater detail, starting with economic analysis. Following a six-quarter economic contraction in the euro area, recent confidence indicators based on survey data have shown some further improvements from low levels and tentatively confirm the expectation of a stabilization in economic activity at low levels. At the same time, labor market conditions remain weak. Looking ahead to the remainder of the year and to 2014, euro area export growth should benefit from a gradual recovery in global demand, while domestic demand should be supported by the accommodative monetary policy stance, as well as recent gains in real income owing to generally lower inflation. Furthermore, the overall improvements in financial markets seen since last summer appear to gradually working their way through the real economy, as should the progress made in fiscal consolidation. This being said, the remaining necessary balance sheet adjustments in the public and private sectors will continue to weigh on economic activity. Overall, euro area economic activity should stabilize and recover at a slow pace. The risks surrounding the economic outlook for the euro area continue to be on the downside. Recent developments in global money and financial market conditions and related uncertainties may have the potential to negatively affect economic conditions. Other downside risks include the possibility of weaker than expected domestic and global demand and slow or insufficient implementation of structural reforms in euro area countries. According to Eurostat's flash estimate, euro area annual HICP inflation was 1.6% in July 2013, unchanged from June. Annual inflation rates are currently expected to temporarily fall over the coming months, owing particularly to base effects relating to energy price developments 12 months earlier. Taking the appropriate medium-term perspective, underlying price pressures are expected to remain subdued, reflecting the broad-based weakness in aggregate demand and the modest pace of the recovery. Medium to long-term inflation expectations continue to be firmly anchored in line with price stability. The risks to the outlook for price developments are expected to be still broadly balanced over the medium term, with upside risks relating to stronger than expected increases in administered prices and indirect taxes, as well as higher commodity prices, and downside risks stemming from weaker than expected economic activity. Turning to the monetary analysis, underlying money, and in particular credit growth, remained subdued in June. Annual growth in broad money, M3, decreased in June to 2.3% from 2.9% in May. Moreover, annual growth in M1 decreased to 7.5% in June from 8.4% in May. The annual rate of change of loans to the private sector weakened further, while the annual growth rate of loans to households remained at 0.3% in June, broadly unchanged since the turn of the year. The annual rate of change of loans to non-financial corporations was minus 2.3% in June after minus 2.1% in May. Weak loan dynamics continue to reflect primarily the current stage of the business cycle, heightened credit risk, and the ongoing adjustment of financial and non-financial sector balance sheets. The bank lending survey for the second quarter of 2013 confirms that borrowers' risk and macroeconomic uncertainty remained the main factors restraining banks' lending policies. At the same time, the degree of net tightening of credit standards for loans to non-financial corporations remained unchanged in the second quarter of 2013 compared with the first quarter, and declined for loans to households. Since the summer of 2012, substantial progress has been made in improving the funding situation of banks, and in particular in strengthening the domestic deposit base in a number of stressed countries. In order to ensure an adequate transmission of monetary policy to the financing conditions in euro area countries, it is essential that the fragmentation of euro area credit markets declines further, and that the resilience of banks is strengthened where it is needed. Further, decisive steps for establishing a banking union will help to accomplish this objective. To sum up, the economic analysis indicates that price developments should remain in line with price stability over the medium term. A cross-check with the signals from the monetary analysis confirms this picture. As regards fiscal policies, in order to bring debt ratios back on a downward path, Euro area countries should not unravel their efforts to reduce government budget deficits. The emphasis should be on growth-friendly fiscal strategies, which have a medium-term perspective, and combine improving the quality and efficiency of public services with minimizing distortionary effects of taxation. To reinforce the overall impact of such strategy, Member states must step up the implementation of the necessary structural reforms so as to foster competitiveness, growth, and job creation. Removing rigidities in the labor market, lowering the administrative burden, and strengthening competition in product markets will particularly support small and medium-sized enterprises. These structural reform measures are essential to bring down the currently high level of unemployment, in particular among the younger citizens of the euro area. We are now at your disposal for questions.
Eva Taylor, Reuters, please.
Eva Taylor from Reuters. Mr. Draghi,
Yes.
First of all, I'd like to know whether the Governing Council today discussed cutting rates and whether the decision to hold rates at 0.5% was unanimous. And my second question is regarding forward guidance. You just confirmed the forward guidance you gave in July, and the market impact that you had in July fizzled out until now.
I'm sorry,
It fizzled out. I mean, it had an impact, and then the impact weakened. Now, other central banks started off like the ECB. They had a vague form of forward guidance, and then they progressed on and introduced a more explicit way of forward guidance. And I would like to ask you, would you rule out that the ECB could go down a similar path? Thank you.
Thank you. So incoming information has confirmed our previous assessment. Underlying price pressures remain subdued, as does money and credit growth. Incoming survey data in July showed some further improvements from low levels and tentatively confirm the expected stabilization. So, against this background, our monetary policy stance remains accommodative for as long as necessary. We have basically unanimously confirmed the forward guidance we gave last time. We want to be clear, and this responds partly to your second question, we want to be clear about our assessment of the inflation outlook in the medium term and about our reaction function. And we want markets to see our reaction function timely linked to outlook for price stability. So I repeat here what we stated, and this was unanimous, confirms that the Governing Council confirms that the key ECB interest rates, including the rate on the deposit facility, to remain at present or lower levels for an extended period of time. This expectation continues to be based on an unchanged overall subdued outlook for inflation extending in the medium term, given the broad-based weakness in the economy and subdued monetary dynamics. So how long will this horizon be? As long as our assessment that inflation remains subdued, as it is indicated by weak economic activity, weak credit, weak monetary aggregates. So, as I said, this assessment was unanimous. All interest rates, including the rate on the deposit facility, are part of the statement. At the same time, let me stress once again, liquidity will remain abundant. It will stay ample as needed, as long as needed, so as to guarantee full access to banks, and the fixed rate full allotment will stay in place at least until July 2014, although, let me tell you, there is no connection between this date and the extended period of time to which the forward guidance refers. Let me also say that current expectations, and this partly responds to your last question, current expectations of rate hikes in money markets are, according to our assessment, unwarranted by our assessment. The risks, as I've said, current data confirm our baseline scenario, and risks are on the downside. So developments have to be significantly better than our current baseline scenario for our outlook for price stability in order for us to change guidance. Thank you.
Johanna Trick, Market News.
Johanna Trick, MNI. Mr. Draghi, how confident can you be in your outlook of a gradual recovery given credit contraction that is at least in part driven by the supply side? And since your last measures didn't appear to have done much to spur credit growth, how much longer can you wait before launching targeted measures that could help credit? Follow up, I don't think you really answered the question on the decision on interest rates. Did you discuss cutting them? And was that decision unanimous as well? Thank you very much.
Thank you. Again, to the last question, we discussed our forward guidance, and that was unanimously decided. Now, on credit growth, our last measures really, I'm not sure it was completely ineffective. I think it was effective in compressing volatility. And given the fact that it's very hard to assess the effectiveness of these measures in the midst of lots of other communication, quite, I would say, abundant and powerful, and from a variety of sources, it's not easy to assess it. I would definitely say that in terms of compressing volatility, it was successful. And I would say that in terms of rates, short-term rates, it was partly successful. In other words, it depends very much which rates you compare the current ones with. So you would see that if you compare them with rates prevailing a certain date, it was successful. If you compare them with rates prevailing before the FOMC statement, it was partly successful. On credit growth, we have to acknowledge that the underlying loan growth over the recent quarters remains subdued and has been subdued for quite a time. We know that there are several reasons for that. First and foremost, weak economic demand. Second, heightened credit risk. Third, the continuing deleveraging by households and enterprises. On the supply side, we know that fragmentation is still an issue. So we should expect an improvement in all these factors. Let me give you, for example, a list of, well, a quick example of improvements on the fragmentation front. We continue to witness capital inflows. We see that the dispersion, the cross-country dispersion in the growth rate of deposits for the banking system is now at the same level as it was in 2007. So if we look at the deposit component of bank funding, I would say fragmentation is over. It's not an issue anymore. On the lending side, however, we still witness some fragmentation. But again, if one really wants to give you some sort of a little more, I would say, upbeat piece of news, one would look again at the cross-country dispersion about lending rates and would observe that that has stabilized. In other words, it has not increased. We also know that credit growth is a lagged indicator of growth and the real economy, and so we do expect credit trends to improve, but with a certain delay with respect to the improvement of in the real economy.
Rolf Benders, Handelsblatt.
I'd like to know if you discussed tying the forward guidance to a quantitative threshold or trigger.
I'm sorry, whether we?
If you discussed to tie the forward guidance to a quantitative threshold or trigger, or if we can expect that this is a discussion that you might have wanted to do in the future, and so that we can expect that this is going to be introduced anytime soon. The second question is if you discussed introducing minutes and where this issue is standing.
Now, on the first question, no, we didn't discuss that, but I should say that our formulation of forward guidance is in line with our strategic framework, which is anchored on our assessment of the medium-term outlook of inflation or price stability. And this outlook is conditional on economic activity and on money and credit developments. So this is our strategic framework, within which we can say that inflation expectations, medium-term inflation expectations, remain firmly anchored. So within this framework, we didn't discuss the introduction of thresholds or quantitative benchmarks. On the minutes and communication, let me say, first of all, that we don't start from scratch. All central banks have changed their communication throughout the years. This central bank did change its communication with the, probably all of you are too young to remember, but with the introduction of the publication of forecasts a few years ago, and even earlier, with the precise definition of inflation, of the inflation objective. Other central banks have come to take our customs and introduced press conferences in their communication strategy. So it was only natural that the Governing Council asked for a richer way of communicate our deliberations beyond what is already a fairly transparent way of communicating, because I've gone through this several times. We have monthly press conferences, we have the bulletin, we have many speeches, and other forms of communication. In any event, also given the increasing complexity of certain type of communication, but also in the long run, the Governing Council thought that it would be wise to have, as I said, a richer communication about the rationale behind the decisions that the Governing Council takes. At this early stage, I can only be relatively general. I think this communication, as I said, should give an account of rationale, of why certain decisions have been taken or why they have not been taken, and a sense of the discussion that has taken place within the Governing Council. On the other hand, we are not a one-country setup. We are not the United States, we are not the United Kingdom, nor Japan. We are a 17-country members of the euro area. So it's especially important that any modification we introduce would not put at risk or into question the independence of the members of the Governing Council. I should remind all of us that Governing Council members sit around that table in their personal capacity. They are not representatives of their own countries. They are acting in the interest of the euro area, the euro. So any change in communication should be respectful of this essential ingredient of our monetary policy, which is, in a sense, at the basis of the credibility that this institution has acquired through the years. More specifically, the Executive Board will present to the Governing Council a proposal for discussion during the next fall. This fall. Next fall will be. Thank you.
Marc Schiris, die Zeit.
Yeah, thank you, Marc Schiris, die Zeit. Two questions on forward guidance. it is still not exactly clear or entirely clear to me what the difference between forward guidance and just a forecast of the economic and outlook for the economy and inflation is. And could you tell us whether there actually is a difference, whether there's an added value that you add to a forecast? And on the minutes, I mean, one of the reasons that the ECB has not published minutes so far is, as you mentioned, the fear that debates will be politicized. And I'm wondering what made you change your view on this risk. It seems to me that the debate in Europe has even become more politicized in recent months, not less. So why did you change your stance here? Thank you.
Thank you. To the second point, clearly that's where the challenge is. To be able to provide you and the markets with a greater and richer information without putting into question the independence of the Governing Council members, without politicizing the discussion, because that would certainly be a big loss. So that's where the challenge is. And we hope we will be able to cope with this. On the first question, it's not really a forecast, it's more than a forecast. We are saying that, I will repeat the statement, we do expect, no, it's not, it doesn't say it is expected. It doesn't say, I don't know, an institution, an international institution expects. We, the policymakers, expect the key ECB interest rates to remain at the present or lower levels for an extended period of time. So it's an expectation by a very specific set of policymakers. Thank you.
Stefan Riecher, Bloomberg.
Good afternoon, Mr. Draghi. Stefan Riecher with Bloomberg. First question on the economy. You commented on improved sentiment and the situation getting better. A very simple question. Are we still in recession or are we already out of recession in the euro area? Second question, I will give it another try. Was the decision on interest rate cuts or no interest rate cuts unanimous or not? And if you don't comment on it, why don't you comment on it? Or maybe I missed it, then I apologize. Thank you very much.
I'm sorry, what did you say last?
If I missed it, I apologize. If you did,
No, you didn't miss. I mean, we
you.
actually discussed only forward guidance, and within that forward guidance, a confirmation of forward guidance, you have an implicit decision about today's interest rates. And the decision about forward guidance was in fact unanimous. By the way, it's not a decision in the sense that we take a decision each and every time. Here, I should say something. There was some discussion on whether we should repeat these words each and every time. And I mean, the words are, the Governing Council confirms that it expects the key ECB interest rates to remain. Now, because of an excess of prudence, we repeated them today. And but we may not repeat them if we judge that you and the markets understand that a certain forward guidance is valid until further notice. So in other words, we may not repeat if we are convinced that you and the markets understand that if we don't say anything, it doesn't mean that we've changed mind. It means that we stay with the same mind until we do change mind. But that's an aside issue. I think I've responded to your first question. On the second question, again, I can refer to our statement here. It says, recent confidence indicators based on survey data have shown some further improvements from low levels and tentatively confirm the expectation of a stabilization in economic activity in the second part of the year. In other words, it seems that the signs we are seeing now confirm the baseline scenario of the ECB staff projections for the second part of the year. Thank you.
Brian Blackstone, Wall Street Journal.
Brian Blackstone with Wall Street Journal. I want to get back to a point you said before. I believe you said that current expectations of rate hikes in money markets are unwarranted by your assessment. Yeah. Is that kind of a warning in a sense that if that doesn't change, next month you might cut rates, or next month you might take concrete steps if you consider to see money market rates as being unwarranted by your assessment? And I kind of want to get back to this rate cut question, because in this whole discussion of minutes and increased transparency, how can you have the forward guidance and an easing bias, and not have an easing bias, without having a discussion of rate cuts? Why do you have an easing bias if there isn't even a discussion within the governing council as to whether or not it makes sense to cut rates? Thank you.
Thank you. On the first point, I would say that we don't work on hypotheses. It's an assessment that we give it now, and we will certainly assess the situation based on the incoming data and on our medium-term assessment of economic activity and money and credit conditions, and of course the medium-term outlook of prices and inflation. On the second point is we've expressed a forward guidance. We haven't reached the zero bound. Keep in mind, we haven't reached the zero bound. So we have given a forward guidance. We've said that based on our medium-term outlook of inflation, conditional on economic activity and money and credit, interest rates are expected to stay where they are or go lower. And that's the key thing. And so we will, and that is valid for an extended period of time. Again, let me stress that there is no precise deadline for this extended period of time. As a matter of fact, you can, like some of your colleagues have done, extract a reaction function and then from there estimate what would be a reasonable extended period of time. And you know that some of your colleagues have done that. Thank you.
Alessandro Merli, Il Sole.
Alessandro Merli, Sole 24 Ore. After the mid-July meeting, you issued a communique with some rules, changing the rules for the collateral. The communique calls the changes broadly neutral, if I recall correctly. The net impact, though, will be positive for core country banks and negative for Italian banks and even more negative for Spanish banks. Isn't this the opposite of what is needed at the moment? I mean, these are exactly the two countries where credit is lacking. The other question is about forward guidance again. You just explained the question about extended period of time, etc., and that you may not even repeat the rate decision in every communique. But another member
only if we judge that you understand.
Right.
That doesn't repeat.
Right.
Doesn't mean that we've changed mind.
Okay, but maybe you're going to ask questions to us at the next press conference.
Good. Yes, that's right.
Another member of the executive board said that the forward guidance would be revised monthly. Is that correct?
No. Well, he didn't say that, as a matter of fact. He said that what he meant to say is that we may have to repeat it every month because we are not sure that you would actually get it unless we do it. So that is what he meant. But it's certainly, you can see the point. I mean, the point is that if we repeat every month, you could infer from this that actually it's not forward guidance for an extended period of time, but only for a month. And that is certainly not what the Governing Council wants. The other question on collateral, let me first state with some emphasis that the decisions we've taken do not weaken the Eurosystem collateral framework. That the objective of these decisions was to have a consistent treatment of all classes of eligible collateral. To have consistent treatment means to enhance risk equivalence across all assets, all eligible assets. Let me give you two examples. First, on ABS, we now have lower haircuts than we used to have before because of transparency and standardization on this asset class has improved, significantly improved. Also because of the ineligibility of mixed pool ABS and close links provisions and servicing provisions. So there are lots of technical reasons why this asset class would deserve a lower haircut. At the same time, the single A requirement remains more stringent than for the other asset classes, as it is defined on a second best rating basis. So the second best triple B ABS remain acceptable in the temporary framework only. That's one example. Another example is we looked at covered bonds, and there we distinguished now between retained that are more risky and therefore they deserve a higher haircut, and non-retained that are less risky and therefore they have a lower haircut. Now, this had overall a minimal impact on the overall collateral, and we will certainly review it at the proper time. At country level, we estimate that the actual impact has been at most around 1%. Now, you have to judge this negative impact, that you are right, went in this way, against the positive impact had previous decisions had, as far as some stressed countries are concerned. So it's, you have to look at it in a dynamic way across the overall sets of decisions. Let me just give some of these decisions. On December 2011, we lowered the rating requirement and issuance for some ABS, and we introduced the additional credit claims. On June 2012, we eased again the conditions for ABS. On September 2012, we allowed ABS and loans and credit claims in other currencies. So you have to judge the most recent decisions in the context of the previous decisions, which have broadened the collateral and the classes, the treatment, ease the treatment on eligible assets for collateral. I think that's the way to look at this. Thank you.
Tonia Mastrobuoni, La Stampa.
Yes, two questions. The first is, I'm coming back to you to ask you if you see any risk of deflation in Europe or in some European countries like Portugal. And my second question is on the minutes again, because you said it. I mean, you're 17 countries and you represent, and from the 1st of January, 18 countries. Don't you fear, why do you take this decision? Don't you fear that some of your colleagues may feel that they have to represent in future more nationalistic issues?
On the first question, we don't see, if we define deflation as a generalized fall in the price level across broad categories of assets, sectors, in a context of self-fulfilling expectations, we do not see deflation in any country in the euro area. We see price falls for selected commodities or sectors which are due to a variety of reasons, whether you have some waning off of the effects, one-off effects of the indirect taxation, or we see other local effects of different kinds, or you see genuine price readjustment, relative price adjustments. But we don't see deflation, basically. We don't see deflation for any country at this point in time. On the other point, I think I made. If we were to have if we were to come out with a communication that would put into question the independence of the members of the Governing Council, we clearly failed. We would have clearly failed. So I would rule this out. I think there is some added value in communication only to the extent that this pillar of our credibility is not going to be threatened. Thank you.
Michael Steen and then Mark Schroers, please.
Hello, Michael Steen, Financial Times. Mr. Draghi,
When the legal Acts are ready?
No, I think I ran out of road on that one last
Okay.
month, so I'm
Okay.
working on a new hardy perennial, but don't have it yet. Just going back to the forward guidance, so I understand that we should assume it's carrying on unless even if you don't repeat it every month. But then the question is, how do we know if forward guidance has ceased? Would the first signal be that you raise interest rates? In which case, how do we, or would you first say we're now at a position where we feel forward guidance is no longer appropriate, and then, but you might still hold rates?
Well, now you're asking me a second derivative question, really, or third derivative question. We've just introduced it a month ago. Now you're asking me what signals would we give in case we were to change forward guidance in the coming months. You know very well that another monetary policy jurisdiction is now struggling exactly with this problem, whether it should do it through interest rates or language which hints at tapering, or change some liquidity provisions. Now, or even change in the assessment. In our case, we have all this we have an equivalent variety of ways to signal this. But certainly, if we go back to the statement here, we say that this expectation of interest rates, I will not repeat it, continues to be based on an unchanged overall subdued outlook for inflation extending into the medium term. So that is one thing one should look at. Conditional or given the broad-based weakness in the economy and subdued monetary dynamics. I think you have all the parameters in your hands to judge about the length of time and especially about when the language about forward guidance might be changed.
Okay.
They're not, admittedly, they're not specified in quantitative terms as thresholds, because, as I said before, our strategic framework is different, and it's rooted in the assessment of the medium-term outlook of inflation. But they are expressed in qualitative terms.
Okay. And just a supplementary question on minutes. You already gave us a small idea of where you're going on this. There's going to be the proposal in the autumn, but can you give us your thoughts on how this could work? Would it be conceivable that the minutes reflect the discussion without saying who said what? Would you be publishing them with a month's lag like other banks, or would you follow it up with a transcript?
I prefaced my remarks on the minutes saying that, on the communication, saying that at this stage I have to be very, very unspecific. It's just the beginning. It has to be also, we've got to be cautious about putting forward our own views, our own personal views about what we would like to see, for two reasons. First of all, because it's a highly complex discussion in our specific institutional setup. And second, because it's one of those decisions that has to be truly, I would say, consensual. All governing council members ought to feel at ease with what will be produced. So I urge caution on this discipline, and unfortunately this doesn't allow me to be more specific than I am being now.
Thanks.
Thank you.
Yes, thanks. Mark Schröers with Börsen-Zeitung. The first one is on inflation. The Fed stated yesterday, and let me quote, the committee recognizes that inflation persistently below its 2% objective could pose risks to economic performance. While you very much emphasize the positive benefits of low inflation for real incomes and domestic demand and the economy. So does that mean that you're less worried about the consequences of too low inflation for the economy? And the second question is on liquidity. You said that there is a need for ample liquidity in the banking sector, but we have seen the excess liquidity in the banking sector coming very close to the 200 billion threshold. So is this something you're worried about? Is there a need to act, or could it fall below the 200 trigger some action by the ECB? Thank you.
Now, on the first question, On the first question, well, the answer is no. No, in a sense, to be sort of to be oblivious to the low inflation. We are not oblivious to having an inflation which is significantly below our objective. Not at all. So much so that the forward guidance says exactly this. It says that we expect the ECB interest rates to remain at present lower levels for an extended period of time, and this is based on a subdued outlook for inflation, which extends itself into the medium term. So we are not at all oblivious to the fact that the inflation in the medium term undershoots our objective of inflation, close but below 2%. We also say that the justification for this is the broad-based weakness in the economy and the subdued monetary and credit dynamics. So I think I answered your first question. The other question is about liquidity. I said that, and I'll restate, that liquidity will remain ample as long as it's needed. And I said that a fixed rate full allotment will stay in place at least until July 2014. Basically, I said everything I want to say about liquidity. Yeah, thank you.
Klaus Ranajakis.
Klaus Ranajakis, AD German Television. Mr. President, you've shown that there are some slight improvements in the euro area in economic terms. You also showed the risks which are still there. 1 year after your speech in London, which certainly is a turning point in this crisis, could you please tell us where do you see where we are standing now at the moment in this crisis? And secondly, what would you say, did the governments in the euro area have used this time which the ECB Council has brought them by the measurements? Have they used them sufficiently? Thank you.
Thank you. Well, let me welcome this question because it's an opportunity to take stock exactly what's taken place since then. Indeed, the Governing Council's actions of last year's summer had some immediate benefits, and we've gone through these benefits several times. Spreads narrowed, rates lowered, volatility became significantly lower. That is to say, basically, it produced a normalization of financial markets. The second positive consequence was a reduction of fragmentation on the funding side, as I did say before, and now we start seeing something on the lending side as well. But it's just the very beginning. Third, we saw the beginning again of capital inflows in the euro area, which is still continuing. More generally, OMT has decreased the riskiness, the general riskiness in the euro area. And this is being shown by a variety of indicators, one of which is the significant reduction in the target 2 balances, with great benefits for the creditor countries. Also, we saw, following the general reduction in riskiness, we saw a reduction in the size of the ECB balance sheet. So, and we saw obviously a reduction, a significant reduction in risk premia, if we look at what the stock markets did and in general capital markets. So what all this was basically necessary to reactivate the 2 channels through which this stimulus would finally reach the real economy. The interest rate channels, because they went down, and the confidence channel, because risk went down. But I also cautioned against, because I mean, people would be, you would have people who tend to think that OMT is the response to all the problems in the world. And so I cautioned way back in November last year I was asked whether I was satisfied with the financing conditions. The answer was no, we are not satisfied at all. We are observing a fragmentation of the euro area, difference in the cost of funding that go beyond fundamentals. Our priority now is to repair the monetary policy transmission channels so that our monetary policy will actually deliver. And that's where we are. We have a lot of work to do yet on that front. And now we start seeing possibly the first signs that this significant improvement in confidence and in interest rates is finding its way through to the economy. But as I said, these are tentative signs. Thank you.
Philipp Plickert, FAZ.
I'm sorry, so you had another question?
The second question, please. Do you think that the governments in the euro area actually have sufficiently used the time which the governing council by these measurements actually have brought to them?
I would say that some of them certainly did. In some of them, there has been significant progress. In some others, less so. But by and large, if you look at, if you just disregard our action, the ECB action, and you look at the policy implementation, I think the progress has been quite significant since a year ago. On all grounds, certainly on the front of fiscal consolidation. On the front of structural reforms is more staggered. In other words, you had countries which have undertaken more reforms than others. But all in all, the picture seems to be better from all angles than it was a year ago.
Philipp Plickert, FAZ.
Mr. Draghi, one question which refers to the previous question again, but you didn't give any examples of governments reforming strongly and others which are lagging. In your assessment, in your introductory statement, you say one of the downside risks is slow and insufficient implementation. If we remember more than 1.5 years ago, you and the then president of the ECB, Mr. Trichet, wrote a letter to Rome, to the then Prime Minister, and you asked for reforms. And if you compare the letter and what has been done since then, and what reforms are implemented and what reforms are kind of revised or even put backward now, so what is your assessment of Italy's reforming agenda?
I'm sorry, I have to answer like I do with your Italian colleagues. I don't comment on Italy. But more generally, I can tell you that some countries, take Greece, for example, there was a labor market reform, bank recapitalization, fiscal consolidation, the same thing in Ireland, the same thing in Portugal. To some extent, labor market reform had been undertaken in Spain, and we can see clearly the benefits. Look at the results more than looking through the list of reforms. Look at the results. If you look at the fiscal consolidation, you observe a few things. Let me give you a few numbers here because I think that would help you. Now we have increase in the fiscal consolidation. If you look at structural improvements all across the board, I don't think you can find one country which hasn't improved. And overall, the improvement is really very significant. If you look at current account surpluses, the actual figures are quite impressive. You have strong increases in exports, not only in Germany, but in Spain, in Italy. So this shows that something has taken place in reforming and enhancing competitiveness. And of course, you have all the other effects that I mentioned before. You had increase in stock markets, you had decrease in spreads. And do you think that all these improvements in financial markets were only due to OMT? I mean, I thank you so much, but I think we shouldn't exaggerate this too much. I think much of this was due to the government's actions and also to the significant progresses that have taken place last year on the euro area governance front.
last question to the gentleman there.
Yes, the Frankfurter Neue Presse. My name is Kutumanos. I've got two questions on the publication of minutes. The first one, in your opinion, would the publication of minutes show that Bundesbank and ECB are not as far apart as the German public has been made to believe? And the second question, do you think that the publication would weaken the need for dissenting members to communicate individually in public? Thank you.
I think all this is would be nice things to achieve, but at this point in time, for me, it would be, as I said before, it would be highly premature to comment on the specifics of what we, meaning the Governing Council, will be able to produce in terms of improving communication on this front. Thank you.
Thank you very much.